Hello everyone, and this video is going to be about finding the highest probability trades at the right time, the entry points of the stocks and commodities that we buy. And how do we do that? Well, I'm going to show you an indicator or two of how we do it. These are the most powerful stocks on the market. These are the ones that are in the 52-week high range. They are making 52-week highs constantly, perhaps throughout the whole year. Why are the 52-week high stocks the best? Well, it takes something special for them to get to that point in the first place. They're breaking an old year high. 52 weeks is about a year. They're breaking that high, and then they're breaking it again and again. And what causes stocks to break the 52-week highs? Well, first of all, once they break the 52-week high, think about that. There's not much resistance left there. They've just broke a new high, and they don't have this overhead resistance, and they're free to move higher quicker. Second of all, there are companies that have good products and good earnings and good sales that got them to that 52-week high. And that's a good thing. That's what we want. We want good companies with good products. That's why they move the most. Also, we want the top groups. And in order for groups to be the top, they can't have stocks in them that are not moving. These stocks, the reason the groups are moving is because the stocks that are in that group is what makes up that group, and these stocks are moving. They're moving the most, and they're in the 52-week high. So our candidates are the 52-week high stocks, and all the great companies and all the great stocks have always been in the 52-week high. Apple Computer, Google, Netflix, Caterpillar, you name them, they're all there. And so not only are they the 52-week highs, but I'll be showing you soon the indicator that spots the best entry points, because we don't want these stocks once they're moving and moving and moving. We want them as they come back and make a dip. And I'll show you the best probable place to catch these. Also, we want to trade them. Well, we can trade them either straight out, or we trade them with options. Now, options are considered a wasting assets or a melting ice cube, and 95% of them all expire worthless. So options are not good for most people, because the timing is what matters the most on options, because they have a time value. But the leverage they offer is incredible. And a 10% move in a stock normally is well over 100% move in an option, sometimes 1,000% move, just on a 10% move in the stock. So the leverage is incredible, and they also are a low risk play, because let's say you buy Apple and it's $100 a share. You could buy an option on Apple for around 10% of that, for $10 a share. So for 1/10 of the price of Apple, you're controlling it. And when it moves, it can move 10 times as much as the stock can. So all the way around, it beats everything, but timing is of most important. And I'll be showing you with stocks on charts behind me here in a few minutes how we catch those high probability moves. And it's just incredible. I've never seen nothing like it. And the indicator is what's going to catch it. But before I continue, I want to tell you a little story that I had heard of a man who lived up in the mountains, and this was probably in the 70s or the 80s, and it was before we had online trading. So he would come down to his brokerage office 2-3 times a year. He'd come into the office and make a trade. And then he'd go home, and they wouldn't see him for 3, 4, 5, 6 months. Then he'd come back down, and he'd either sell out or buy another position. And he was very, very successful. And when I heard the story, I wondered for years and years, what did he do? What did he do? How did he know what to buy? Well, I'll tell you what I found out. And that is that most people, they overtrade. They trade way too much. And they dibble and dabble with their profits and with their losses. And by the time a real good trade comes, they don't have the money to load up on that trade. And if you're going to be really wealthy, you need to learn to concentrate your profits. Concentrate your money on a few good stocks, and to not be too overly diversified. So we're going to talk about diversification. And let me tell you what Warren Buffett says about diversification. He says diversification is for ignorant people. It's what they do to protect themselves. Makes sense to me. Rich Dad, Poor Dad, that gentleman, he says they always tell us not to put all of our eggs in one basket. But he says they never tell us to put a lot of eggs in a few baskets. Both men are very smart, and I think they're very right. And so what we want to do is we want to diversify, but we want to diversify properly. And let me get into that for a minute and tell you what makes sense. 4 out of 5 stocks follow the Dow Jones and the broad market indexes. I've seen this. I've seen every group, 250 groups, go down when the broad market was going down. And so if 4 out of 5 stocks follow the broad market indexes, the Dow Jones, the S&P 500, or the NASDAQ, if they follow those indexes, then what happens if you had a stock in 5 different groups or 10 different groups? Is that diversifying? I don't think so. You could have 10 different stocks in 10 different groups, and 8 of them are still going to go down when the broad market dips or corrects or crashes. That's not really diversifying. So I found a much better way to diversify, and you tell me if this doesn't make sense. Okay, you trade 1, 2, 3, 4 of your positions in stocks, in the good stocks, the moving stocks, okay? As long as the broad market is moving up. You don't trade those if the broad market is making its dip and it's confirmed. I'll show you that later. Okay, so a few stocks in the stock market. 1 or 2 positions in the commodities market, but not with a futures contract. That's super high risk. No, but in an options, where it's a limited risk. Okay, so you have a couple positions in commodities. It could be coffee, corn, wheat, silver, gold, orange juice, those kind of commodities. And then you have 1 or 2 positions in ETFs, exchange traded funds. They could be world exchange traded funds. They could be Brazil, China, India, Germany, Russia. Those kind of ETFs that's not really affected by the stock market itself. So now, is that not diversification? You got 2 positions in stocks, 2 positions in commodities, 2 positions in ETFs. That's a much better rounded way to diversify. And these are not slow-moving diversifications or assets. These are fast-moving things like orange juice and coffee and ETFs that are, of the fastest-moving groups. Okay, so what did we do? We diversified, not too heavily, in groups that are different than just stocks. All right, that makes sense to me, and I've seen this work really well. Okay, so we diversify like that. We use options. Some of you, if you don't want to use options, you can use the stocks themselves. The timing is still the same. The options just have much higher leverage. And if you know what you're doing, leverage is what you want. But leverage that isn't going to kill you like the Forex market. They can give you 100-to-1 leverage, sometimes 200-to-1. But if it goes against you, you're wiped out. We won't ever take that kind of chance. We want a limited risk, which an option, if you pay $500 for it, that's all you can lose. And you know that from the beginning. And we have a system that we only will ever take a 30% loss on our option and let the winners run. And those options can easily be 200, 300, 400, 500, 800, 900%. So a couple small losses and 1 or 2 big wins is all you need. You could have 5 losses and 1 win and still make money. But we want the best timing, the best stocks, and the best leverage. And that's what we're set out to do here. Okay, so I'm going to show you, some setups and how we trade them. And stay tuned, and we'll get right to the charts.